And obviously impairment can be ascertained only if you will value that investments and fair value that investments, right? So the concept is there. Even the concept is in CGU, that if you want to value the business or that particular unit, then how you will value that. Value in use, you are aware of under AS 28. So the concept is not new, but the thing is that many times you find the difficulty in working out the fair value. And that difficulty will get enhanced if you have to do lot of assets and liabilities at a fair value. And we have seen that basically assets and liabilities, only non-monetary items up till now we are doing on the basis of a fair value wherever required. But now a lot of financial assets and liabilities, which we have covered partly in IND-AS 109, are also getting valued on the basis of a fair value. And as you know, in IND-AS 109, the options are always there to have fair value through P&L or even through OCI, but the fair value is required. So basically, to start with, this is a standard. So what used to happen earlier was that at many places fair value was defined, at many places certain other terms were defined. However, it was done in a different manner, and that is where the IFRS, ISB, thought that there needs to be a separate standard which deals only with the fair value. And rightly so, because if you were to go for a principles, then you will directly go to this standard and you don't have to search with the other standards. And ISB also had acknowledged that there are certain inconsistency when the fair value was used at all the places. So it was mentioning that certain way the fair value has to be done, which may not be the right way on an overall basis for a consistent approach. So that is why this standard has been formulated. And if you look at this standard basically so this standard basically don't prescribe that when you need to fair value. That is based on the other standards. Next one. So basically, the thing is that this standard will not prescribe that when you need to do a fair value. I think that is very important. This standard only says that how the fair value needs to be measured. And at many places, if you will see, fair value measurement for the accounting purpose may not be required. But at many places, there is a requirement of disclosing the fair value by way of an information. So in those cases also you need to work out fair value on this basis. So either by way of a disclosure or for a measurement purpose and for accounting purpose, you need to do a fair value. Whenever you need to do a fair value, you need to take access to this standard. Today's we will deal with unit of account, which is quite important. Characteristics of assets or liabilities, that's a concept which is there. I think we will deal with that. Highest and best use of non-financial assets, because non-financial assets needs to be distinguished because there can be a higher value in use principal market and most advantageous market, that also has to be looked at in a proper manner, because there is a hierarchy on the basis of which you will go for the market also. If the that particular item is quoted, then also there are certain hierarchy need to follow. Liquidity, whether we need to consider the liquidity or not. Orderly and disorderly transactions, what can be considered as orderly transaction, because it's important to know that only orderly transactions can be taken into account when you are working out the fair value. Active and inactive market and valuation techniques, which will deal with. So basically it defines a fair value, and it's a single source of guidance, and what ISB says that it will improve the consistency and the comparability, and that is where fair value disclosures, there are enhanced fair value disclosures, because it's not enough that you will disclose the fair value. You need to ascertain that, you need to actually define in your disclosures that how that has been valued, what techniques you have utilized, at what level you have done, you have used the observable data, unobservable data. So we'll deal with that, but so much of disclosures are required that up till now what we are doing, up till now if that fair value needs to be done, and if you want to use the expert, you will take the valuation report, you take that amount and just use that. That is not going to be enough for this standard, because this standard disclosures will say that what are the assumptions which you have utilized. If assumptions are not found to be correct, what will be the impact of that, and all these things will give enhance knowledge for the reader of the financial statements, but for us, for the preparer and for the auditor, it's going to be a slightly difficult task. So you need to be mindful that when you are using the work of the experts or any valuers, which in many cases it will be required, you need to sit with them, understand that what is how they have worked out, and maybe some of the things you may have to narrate that in the notes. So fair value, which has been defined, the price that will be received to sell an asset or paid to transfer the liability. So it will be always opposite in a liability in an orderly transaction. So we will also find out that what can be considered as orderly transactions, and between market participants at the measurement date. So I think 4 things are important here. One is the orderly transactions, we'll just look at it, and market participants. I think earlier also Vidyadhar had mentioned that one is to look at from the angle of market participants and not from your angle. So if you have, so I think there was a discussion that whether synergy can be taken into account in 103. So synergy cannot be taken into account, because market participants, what they will look at it, your synergy will be only in respect of your thing, so that cannot be taken into account. So like that, it's very important that you have to look at from the market participant point of view. You may be taking certain things into account. If market participants are not likely to take that into account, then you should not take that in a valuation.
Probably, if I can just add, this is a very important point from a business perspective, because here we have corporate attendants as well as people from the fraternity. And talking about valuation aspects, as we always been talking about that, and the earlier point that he also made regarding assessment of the assessment and analysis of what the fair valuer has done from the fraternity perspective and auditor's perspective. Today, if you are not used to fair valuation methodologies or the way in which valuations are performed, it's going to be very tough for you as an auditor to make notes and be cognizant of the fact that you are signing off a balance sheet and financial statements just by relying on the work of an expert. It cannot be just like that. Though you have standards which talk about how do you rely on the work of an expert and what do you do, but please ask yourself this question at the point of end of the day, whether you did justice to understanding what was presented to you, number one. In the same light, this discussion about synergies and non-synergies, you see, normally a acquisition or a target or a business acquisition happens only when you see a synergy in the whole process. If you believe that you are a contract manufacturer in a say pharma company and you want to go and acquire another company, the whole aspect would be synergization. If I were in a different country and I wanted to use the outsourcing mechanism of the contract manufacturer in this country, I would say that, well, I will transfer all my, if possible, all my controls of a manufacturing facility to India, say for example, or Mexico, and take the benefit of that synergy. That is very important from a business perspective. And what he meant to say was, and I'm sure you understood again, just for reiteration, that the synergistic aspect has to be looked at it from a independent buyer and independent seller perspective, and that's how this market participation drives. If you say that I am ready to pay an X price just because of the synergy, and if that is the whole thrust of the situation, let it come out in the valuation in various intangible aspects that come in, because there is no such thing as synergy that comes from the balance sheet, though it's an intangible aspect. So just wanted to bring that.
No, that's right. I think it's very much right. And when we are talking about from a purchaser side, I think we should also not look at what will be the price which seller is expecting. I think it will be both ways, because there are many things where, let's say you want to just close down or you want to wind up your business, you may sell the assets maybe at a cheaper price, right? So you don't consider from a seller's point of view or a buyer's point of view. I think that is very important, which you need to keep in mind. What the normal market participants, so in the market, if somebody is there, what he will pay, I think that is important. And of course measurement date is there, so if anything is done after the measurement date, then you don't have to consider that. But the thing is that it has to be based on an exit price. I think this is very important, we will deal with that, but you should keep in mind that it will be based on the exit price and not the entry price. So that we need to keep that in mind. As I was mentioning, that it does not change when fair value needs to be worked out, that is covered by the other standards, but wherever fair value needs to be worked out, then the standard will be useful. And it does not, so basically another important thing which has been taken here is that we are also today used to a transaction cost. So whenever we purchase any asset, and if we say that if any cost which is incurred directly relating to that transaction, we will generally capitalize or consider in a fair value, right? The standard prescribes that transaction cost cannot be considered in a fair value. Okay, I think there is a good reason why transaction cost should not be considered. Because today buyer A may incur transaction cost of 1%, buyer B may incur some 2%. So when there is a transaction cost, and transaction cost will not add the value. You know, when you are doing a fair value, we are valuing that particular asset or a liability. It is not, transaction cost is not going to add the value. What we generally do up till now is that because we are going on the basis of the historical cost, okay, we add the transaction cost as a part of the cost, and then still we will work out that what is the fair value. When we will work out the fair value, at that time many of the people up till now were considering a transaction cost, but from now onwards we cannot consider a transaction cost. So that's a big change. So when you don't consider a transaction cost, it will hit your P&L. So let's say if you are doing certain acquisition, you are paying something to the lawyer for the agreement, you do due diligence, you spend a lot of amount on that, then maybe you will be using merchant banker, so you will be paying to it. So all this cost is maybe substantial in many cases. So generally the cost, transaction cost is between 2 to 10%. So though it is a substantial cost, what it says is in fair value you should not take that into account, and that is where on the initial measurement it will hit your P&L. I think that we need to keep in mind now.
Yes,
yeah.
Academically, how does this differ from realizable?
Yeah, so we'll deal with that, but realizable value is different. You rightly said, I have dealt with that. In fact, standard is dealing with that. In realizable value, you will consider the cost of selling. Okay?
But that is not realizable.
Yeah. No. So realizable value generally you will consider cost of selling, which here it says that the selling cost.
Only on last point, overall fair value market, fair market value and realizable value. What's the differentiation?
So realizable value always will be from the point of the seller. See how much I will realize, and that is where it says that you have to look at from the market participant point of view. So you should not look at from a seller point of view, because always you will keep in mind that when I am selling, how much I will realize. That is not required, because if you look at advantageous market and all that is coming there, also the concept is clear that realizable value can be different. So you should not consider realizable value. This we have dealt with fair value measurement when assets or liability, both financial and non-financial, or for a disclosure requirement. So it's important that even for non-financial transactions, non-financial assets and liabilities, this standard will be applicable. So when you are doing an impairment, when you are testing some investment, when you are loans and advances, when you are looking at provisioning against that, basically it will be done on a fair value basis, and that is where this standard is going to be useful. It doesn't cover share-based payment. See, because all these are particularly prescribed in the standard itself, so that is why it doesn't cover share-based payment, it doesn't cover leases, and mainly inventory. So here when we are talking about inventory, it is net realizable value such as, so there net realizable value is considered. Okay, so when you are taking here also, when you are talking about realizable value, you look at from who is holding the inventory. If he sells, then what it will realize. So that is not required anymore now. Because there is a concept, as you know, in IAS 36, we have covered that IAS 36, right? So in IAS 36, there is a concept of value in use. I think it is similar to AS 28, what we are dealing with. And most of the time, you consider value in use because that will be the higher value which you get. But value in use is not getting covered by this standard. So somebody can say that when you are using a valuation technique, whether value in use you can consider or not. See, valuation technique is not relating to working out only value in use. It is generally considered the technique which market participant will use. Okay, if that is where if you have certain assets and the other assets which you are valuing, it will be complementary to that, you may get a higher value in use. But when you will independently value that, you will not get that value. So that concept of value in use you cannot directly take into account, but some of the valuation techniques which you will be using for working out value in use, maybe that may be relevant here. Okay, so not directly relevant, but the techniques definitely is getting covered here. Of course, employees benefit, as we know that it needs to be most of the obligations needs to be worked out on the basis of the actual valuation, and recoverable amount under impairment of assets based on the fair value less cost of disposal. Right? So recoverable amount is mainly, one can also say that it is a reserve value, but recoverable amount can be at a later date when you are finally not going to use that asset in disposing of the asset. So of course, I think as we have learned, it needs to be discounted when you are working out the provisions against that. So let's see what is the framework. Unit of account. I think unit of account is going to be very important, because many times when you are valuing particularly certain securities, equity shares, then this concept of value of account, unit of account is important, because certain things you will not be able to take into account. So we will deal with that. Once you work out what is the unit of account, then valuation premises which you need to work out, whether highest and either valuation premises which you will be dealing with, or highest and best use. So highest and best use, as we have seen, will be generally for a non-financial assets, and otherwise you need to work out on a value of valuation premises. Exit market, principal or most advantageous market. So we have seen that we need to consider the exit price. So for an exit price, they are saying that one needs to consider what is the rate available or quote available in the principal market. We'll deal with what can be considered in the principal market. If principal market is not ascertainable easily, then we will go to the advantageous market, most advantageous market for you. And that most advantageous market will be particularly applicable to that particular entity. So then that is not common where, let's say, most advantageous market for anyone. It will be particularly for that particular entity. We need to also look at market participant assumptions, what they consider in when they are valuing that. Input to valuation techniques. So as we have said that what are the assumptions which are used, what are the input, whether you have used directly observable inputs or you have used unobservable inputs, you need to take that into account when you are doing it. Indicate value of unit of valuation, fair value measurement and presentation and disclosure. Okay, these are framework for non-financial assets. So so this is for non-financial assets. For financial assets, it will be different, because we will also consider whether group of financial assets or a liability with offsetting risk. Now, this is only applicable for a financial assets. So what basically it says is that there are many times different financial assets, and unless you consider as a group, it may give a different fair value. So it says that in certain cases where there are offsetting risk, I think we have dealt with that when we are talking about hedging, when we are using some derivative instruments. So it's not necessarily only hedging, but when you, let's say, have certain options where call and put options both put together only you are looking at it, So that can be considered as a group of assets, and you need to value that not independently but together, right? So that's what is allowed. So if it is group of financial assets or liabilities, if it is yours, then you have to go to the net long exposure. So what is the exposure? Then market participant assumptions and all that is same. However, if it is not, then you need to work out that what can be considered as unit of account. So that is where I was mentioning that when you are looking at equity shares, the unit of account will be only a particular one share. It will not be a bundle of shares. So when today when we are looking at let's say a company where you want to take a stake and controlling interest, right? At that time what you will do, so other than India, because when you are having a business acquisition, then it gets covered under 103. But other than that, when you are taking a stake which is much higher, you will say that for a total which I am buying, what I am going to pay, or what will be the fair value of that in totality and not on an individual basis. But unfortunately in this standard it is saying that it is not allowed. So unit of account is important. Allocate, sorry, yeah.
Suppose is voting by equipment. Now that equipment is just for the replacement purpose, because holding company has an Indian customer for those equipment. Say example, automated milling machines, AMS machines.
Okay.
Now what holding company says, whenever this machine, suppose is not working properly, so they are sending the spare machine to their subsidiary in India, and they are saying, as and when customer request for that the machine is not working, so that you can supply that spare machine for the purpose, they can use that. So whether I have to apply this IND-AS to that the machinery which lying in the Indian books of account for no value, it is just for the replacement purpose. So I have to apply this IND-AS for those machines also.
Yeah, so what you are saying is that whenever the machinery will not be functioning properly, the other machine which will be given as a replacement, that you will be using, but that will be permanently with you.
Yeah, and at the end of the year, then I will send those machines again to the foreign company. End of the year or whatever that span of time which is given.
So I think the facts are not clear, but what I have understood is that if there is a machinery which is given free by your parent company, or let's say by your supplier also, then what needs to be done with that, right? So the standard actually IND-AS says that nothing comes free. So if something is coming free also, you need to value that and account for that at a fair value, right? So when let's say a parent company, in a case where parent company is giving you certain assets for your use whenever you require or whenever there is a need arises.
For the customer, if the customer is not able to manage that machine properly, that machine got stuck up. So the Indian company will help that machine to be replaced to the customer's factory, and that the machine is not working, I will take it up and I will send it to the holding.
Okay.
And I'm starting like doing something to the holding company from that.
Yeah, so if you are, let's say, giving to your dealers, let's say many times, to the dealers you give certain, let's say, a white good industry, certain fridge or certain TVs for showcasing, and also when it has to be replaced, it will be given. So all these assets and whatever assets which are given for a replacement, so there basically you need to see whether the risk and reward is getting transferred to another person or not. In my view here, the risk and reward is not getting transferred, and that is why you will not be able to account in your books that asset, because that asset doesn't belong to you. That asset belongs to somebody else. So derecognition from the other party to recognize in your case will not be possible, and that is where you don't value somebody else's assets, right? So you will not do that, although physically you may be having. That's not required.
There may be certain elements of embedded value, as you were actually pointing out, about the fair value concept that's coming in, but that may, I think it may need to be figured out as a transfer pricing cost or the overall analysis that needs to be done, because somewhere or the other benefits are getting transferred, not exactly the risk and reward, but certain benefits are getting passed on from the holding company that she was referring to the Indian subsidiary in India and through that company to its customers. So at some element there would
be... only what I will say is that when the benefits are getting transferred, right, but those benefits, the advantage of that benefits are going to move. To my mind, the way it has been articulated, I think the benefit is for the parent company or for the supplier, and that is what is important. That finally who gets the benefit. If you are going to get the benefit, then yes, you need to get it.
Indian subsidiary is just doing a warehousing sort of facility is provided.
Yeah, so it is just helping and keeping certain things, certain assets for for its business.
Basically, I think the India company is acting as a facilitator to the whole mechanism, and there should be a facilitation fee embedded somewhere between.
Yeah, so that's a transfer pricing. Yes, you need to take that into account. But if you have a regularly parent company's machinery only it is being sold, then you can say that it is inbuilt into that system. So we have discussed that unit of account is important only when there is a financial assets or liabilities. It will not be applicable when you are talking about non-financial assets or liabilities. You need to keep that in mind. It defines what is being measured and recognized for financial reporting purpose. So what can be level of aggregation or a disaggregation you will be able to do. Is generally determined in accordance with IND-AS that requires or permits the fair value measurement in the first place. So certain other accounting standards also will be dealing whether what can be considered for aggregation or for a disaggregation purpose, and then on that basis you need to work out what is the unit of account. So let's take this case. An entity holds a large position in a company that is traded in an active market, right? Generally any listed shares. If entity sells its entire holding in a single transaction, the market's normal daily trading volume would not be sufficient to absorb the quantity held, right? So many times you face this difficulty that you say that it is traded, however it has not been actively traded or it is thinly traded. There is a concept of thinly trading. So it means that looking at your holding, the market trade is so minuscule that you will not be able to sell that particular thing on that day, so on a measurement day, or maybe over the next 2 or 3 days also. That single transaction would affect the quoted price and result in the entity receiving a lower selling price. So if you will say that still, if you will forcefully sell your holding, obviously the market price is likely to fall and then the realization will be at a lower rate. So in this case, what needs to be done? Should the entity adjust the fair value of the asset to reflect this? So basically what it says is that when there is no, so it is quoted but there is not enough transaction. So at present what we do is that either we ignore that transaction, right? Ignore that quoted price and you go and look at a different method, right? When it is talking about a unit of account, what needs to be done? So basically, the standard says that unit of account in case of an equity share has to be a single share. It cannot be a aggregation of shares or whatever your holding is there. And though it may be thinly traded, because your unit of account is only one, it needs to be valued at that price. That is what the standard says. So you should not take into account the thin trading which is happening. If it is quoted, you go by that price only. Right? It's very important because at present, in fact, in various regulations also, RBI and even mutual funds, it is talking about when it is thinly traded, you don't consider that price, you take then 30 days average price and everything. However, it says that one should not take this into account. Okay, that's one important change which will be there from the present concept. So, in fact, if you look at the basis of conclusion, of course that is not part of our standard, but basis of conclusion, if you have to look at, you have to go to IFRS standard. And if you look at the basis of conclusion, there were a lot of debates on this. Because rightly, people were saying that it means that if I am taking a controlling interest, I would generally pay a premium, whether I should not consider a payment of premium. If my holding is large and if I am trying to sell that on a particular day, I will realize 10% lower. So whether that should be considered or not. However, finally, it was by majority, it was not by a total consensus, that finally they are saying that you need to consider unit of account for equities as only one share, and on that basis you need to buy. Okay. So as I mentioned, since there is an active market, the fair value of assets or liabilities should continue to be measured as the product of quoted price and quantity held. So there is a concept of P multiplied by Q. So they are saying that basically a quoted price and quantity held, quantity which you are holding, that needs to be multiplied. There is nothing else which you can do in this. The same applies to a liability or a position comprising a large number of identical assets or liabilities, such as holding of financial instruments that are traded in an active market. So, same thing will apply to a liability. If there is a quotations which are available for a liability, you will go for that. So the next concept is, in fact, when you are talking about unit of account, at present, what we may be doing is that we say that when we do a fair value, we also take into account certain premium which you will pay for the controlling interest, right? That from now onwards you will not be able to take that. Or sometimes you use discount because your holding is large and there will not be ready buyer for that particular holding, and that is why sometimes you use discount also. So what it basically says that discount or premium you should not take into account when you are doing a fair value of equity shares or any other financial assets or a liability. Next concept is the characteristics of assets or liabilities. It's important because what it says is that in a fair valuation you will consider only the characteristics of assets and liabilities which market participant will consider, okay, and not to a particular person that characteristics is only for that particular entity or for a person. We'll take an example. So characteristics when pricing of the assets or a liability at a measurement date. So those characteristics which is available or applicable only at a measurement date only you will consider. Subsequently it would have been changed, you will not consider that. Examples, conditions and location of the assets. So can you tell me whether you will, let's say you have an asset available at Hyderabad, okay, whether that will be considered as a characteristics of that asset, because that location is in Hyderabad. You will consider that if I want today in Bombay, you need to incur a transportation cost, right? So location is important, that where that asset is for you and for any market participant. And if that location is important, then it will be considered as a characteristics of that particular asset. And that is where it says that when you are considering the fair value of the tangible asset, you will consider a transportation cost. Transportation cost is different than transaction cost, right? Because transportation cost is only when you have to bring that asset at some different location, that is a transportation cost. It will not be considered as a transaction cost. So that you need to keep in mind. Another thing is restriction on the sale or use of the asset. Many times we find that, right? Restriction on sale or use of assets. So example, okay, you have given to the banker that you will not sell this particular asset or that this particular equity shares unless the loan is repaid. So that is what? There is a restriction on sale, right? So whether in this case, let's say take this example, whether you will consider this as a characteristics of that particular equity shares? Yes. Why? So I think that concept is getting clear here. Basically it says that that is not a characteristics of that asset. It is peculiar to your particular aspect, that you have taken a loan from a banker and you have given that as a pledge, or you have given a undertaking that you will not sell that asset. So it doesn't become then a characteristics of that asset.
If I have mortgaged my assets, how it's going to impact my fair value of that asset?
So
because the bankers have given me a loan on the base of that fair value. If I want to sell that asset, I
need to
don't
repay
need
the
a characteristic restriction on the sale of the use of asset because of the mortgage. It should change. What I can think that if there is a renewable energy like Suzlon is using in remote places of Maharashtra or Rajasthan, I cannot use that in Mumbai because the air quality can make it redundant if I take this machine here. But mortgage, I feel that I still
take
can.
into account.
Yes, because it is mortgage. The buyer will not tell that no, इसका value तो बढ़ गया because it is mortgage. They will pay me. I will take money from you. I will repay back to banker. I will take only NA from.
So tell me, that is what I am saying. That whether market participant will consider that is the first thing. Here the concept of characteristics is different. So it says that if it is a characteristics of that asset or a liability, then only you should consider in a fair value. Otherwise you cannot consider. So in this case, when there is a mortgage, it has been given, fair value will not get changed. Fair value will remain without that mortgage being there. You will work out on that basis. Okay? Because why? It has not been characteristics of that asset. Right? So in general, that asset characteristics and not for that particular asset. Now, take an example that you have, let's say equity shares. It is a quoted equity shares, but as per the terms of the equity shares, you have a warrant and you will not be able to sell that asset, sell that particular equity shares in the market for 12 months. Right? There are many such cases where there are restrictions. There is another class of equity shares. You will not be able to sell that equity shares. Take a case simple, convertible debentures. Right? So compulsory convertible debenture is there, but you will not be getting those equity shares unless it is getting converted. So let's say conversion is possible only after 1 year. If the conversion is possible only after 1 year, you will get equity shares after 1 year and you will not be able to sell those equity shares. So because you don't have those equity shares, you can sell their convertible debentures, but you will not be able to sell those equity shares. So whether that is a characteristics of that particular asset, yes. In this case, because it is linked with the terms on the basis of which those debentures are issued. So if you will look at it in the market also, the convertible debentures, compulsory convertible debentures and equity shares, there will be certain difference. Generally, when you are saying that there is a restriction, you will be able to sell only after 12 months, then equity shares, there people will not be able to pay the same price for that. They would likely to pay a lower price, right? Because always that will be in your mind that if equity shares in those 12 months will go up and then it is temporary and it will come down, you will not be able to sell this. So that any market participants will take that into account. And in this case, it becomes a characteristics of that particular securities.
How do you record the fair value of that equity share? Will you discount for the lack of marketability?
Yeah, so in this case, because it is a characteristics of that asset, you will consider that in a fair value. Okay?
Here we are trying to say that DLOM is allowed.
Yes. So that is what I am saying, that it is important that to find out whether it is a characteristics of that asset or not. If it is a characteristics of that asset, you take that into account in your fair valuation, not otherwise. Right? Now take the same case where let's say certain shares are issued to the promoters. So as per the SEBI regulations, there is certain restrictions on selling those shares by promoters going forward. So I think there is a restriction of 1 year, right? So let's say 1 year, I am not sure on that, but 1 year there is a restriction that that promoter will not be able to sell them. Whether you will consider that as a characteristics of that asset? Is it different than what we had considered earlier in case of a convertible debenture? It's important, concept, and you need to keep this in mind. Otherwise, the fair value will be different. So take a case where, as a term of the convertible debentures, you will be able to get the shares only after 12 months. In this case, that particular equity shares which is issued, if it would have been held by somebody else, that person will be able to sell immediately, right? Because of your particular restrictions, so it depends upon, it's not a characteristics of that asset. It is characteristics of that particular entity, right? That you should not consider. So, when there is although restriction on the promoter's holding sale, you will not consider that when you will do a fair value. So whatever is the quoted price, without any discounting, you will value that. Right? I think it's quite important. So always,
There also the fair value will be different, no?
No, fair value will not be different because the fair value you will look at from the market participants and not from all that you are holding.
But if I am a market participant and if I have to buy those promoter shares, I am not going to take the full value.
Yeah, so what is the unit of account? Unit of account is a equity shares, right? So you will not say that as a block I am going to buy. You will say that if I in a market go and I want to buy one share, what value I will give, and then multiply with the quantity of shares which you are holding.
But practically also, whenever there is a lock-in which is applicable to our share also, if we are holding private limited and we got vested, so there is a 12-month lock-in. There also they are trading at a discount. So what is the market price which is available? So there it is not at the same price which we are able to sell it.
So that is where, what is the lock-in? Lock-in is particular to that security, which in the earlier case it was there, because if you are holding a warrant, let's say, you will get shares only after 12 months or after certain period of time. That will be, warrant will always be at a lower rate which you will get. Okay, but when you are holding and your restriction is there, you should not take that into account. So that's
Because
clear.
probably also he answered this question himself. You said it's already embedded, the discount is already embedded. So here you just have to pick up that one unit and multiply and see, because that effect has already come into the valuation concept. So I would say that you have to look at it from a asset characteristic per se perspective versus the whole entity and all the other. Because it may sound to you that it sounds like a restriction, but it is not a restriction.
It is not a restriction for a.
But you will also have to see whether it is marketable. If it is not marketable, the question is
The lock-in I can't sell it to start with.
So that's why if it is marketable from an asset point of view, you will not consider that it is marketable for you or not. I think that is where the distinction is. And this concept has to be clear, otherwise, if you will give it to any valuer also, he will do it in a different manner. But when as an auditor or as an entity, when you have to comply with this standard, you have to tell valuer if he is doing in a different manner.
So engagement letter should also go through you.
Engagement letter, you should say that it should be as per IND-AS.
No,
But I think specifying this helps.
the valuation aspects, those who are into valuation very well now clearly understand fair valuation, fair reporting, in the sense financial reporting valuation in accordance with IND-AS account or
I think always in that engagement letter it should be there, that it should take into account the principles of IND-AS 113.
Specify because reviewers should not take adverse.
So a good thing which is coming out is that when you are relying on the, as an auditor, when you are relying on the valuation report of somebody else, of the expert, I think you have to tell him to mention that it is valued on the basis of taking into consider principles of 113. I think that will be better, so that at least he as a valuer, as an expert, has also applied the mind that how this 113 will work.
So, in that case, the value which that person will be realizing, that will be net realizable value, but that will not be the fair value.
You're right. Yeah, but you are not doing your any measurement on the basis of the net realizable value, unless on certain other things, inventory standards and all that is there, but not otherwise, right? So here we are talking about working out the fair value, so you should not touch it. Okay, assets or liability measured at a fair value might be a standalone asset or a liability, or a group of assets or a group of liabilities, or a group of assets and liabilities, right? So in certain things, as we are saying that aggregation, disaggregation is allowed, particularly when there is non-financial assets, you will look at only from a group of assets point of view and not from an individual point of view. we have dealt with this one. An entity holds an equity instruments for which sale is contractually restricted for specified period by limiting its transfer or sale to qualifying investors. The restriction is a characteristic of the instrument and would therefore be transferred to a market participant. Right? So here basically sale is contractually restricted for a specified period. And that is why it is a characteristic of the equity instruments, unlike the promoters holding, which they will not be able to see. Fair value in this case will be measured on the basis of quoted price for an otherwise identical unrestricted equity instruments of the same issuer that trades in a public market, adjusted to reflect effect of the restriction. The adjustments would reflect the amount market participants would demand due to a risk relating to the inability to access the public market. Now, I think you had raised an issue that if it is a private equity shares of a private limited company, right? When there is a equity shares of a private limited company, you will not be able to easily sell that, right? Because there are restrictions. Now, whether that is a characteristics of that particular equity instruments, yes, that is a characteristics of particular equity instruments. So, when you are valuing that private, that equity shares of a private limited company, directly it is not quoted obviously. So what you will do is that you will consider other observable data. So if it is in a chemical industry, you will say that the chemical industries which are quoting in the market, the chemical companies, at what rate it is quoting, at what PE it is quoting, at what multiple of book value it is quoting, and you will consider that in valuing their private equity shares. In addition to that, you also need to consider that it is not easily tradable, and when it is not easily tradable, it will be a discount which will be used, right? Now, in this case, you need to, when you are working out, you need to consider a discount. Why? Because it is a characteristics of that particular equity shares, because it is a private company shares, right? So although you may be using, but same thing, if you will be using when it can be easily traded, when it is, let's say there is no price available because it is not getting traded, but it is listed, so it can be traded in the market. In that case, you will not take this into account, any discount. Okay.
So how would you consider the stock which has not been traded since years but are listed on the market? If we have to value that.
Yeah, so that is where it says that on a measurement date it needs to be valued, right? So many times the question comes that on a measurement date, if it is not traded but otherwise it is trading, what needs to be done, right? And going further, it may be said that it has not been traded in last 6 months also, then what needs to be done? So taking from the last one, if it is not traded in last 6 months, okay, you cannot take the last quoted price as your fair value, because it has to be on a measurement date, right? So somebody was questioning that measurement date on 31st March, if it is Sunday, what will happen? Because nothing will get traded, right? So how it needs to be done? You should not go to that extent. I think if market is closed because of the holidays, you have to take the last quoted price, which may be 2-3 days before, right? It cannot be 6 months or 1 month before. So if that is the case, you will take that into account. But otherwise, if it is not traded for, let's say, to my mind, more than 5-6 days, you should not be able to take that whatever is the market price, last traded price into account. So it is observable data is not available for that particular company. So what you will do is that then you will look at the observable data of the similar type of companies. So that will be the next hierarchy which we will cover. So you have to do it on that basis.
I have one question.
Yeah.
In case of listed companies, practically, generally what is happening, we take quoted price as a market price.
Is fair value or we go to some other valuation techniques also?
Many times we have seen that we go to the other valuation techniques where it is thinly traded. Because the concept is when it is thinly traded, you don't consider that because it is not representative of the price.
But what actively if it is traded then?
Sorry?
If it is
If it is actively traded, you will take that into account. But here, in this case, although it may not be actively traded, you will take that into account.
But generally say, for example, like of investment companies, those are generally, traded at 60-70% of the total value of their subsidiaries.
Correct.
So wouldn't we consider it as a fair value even in that case?
Yeah. Because there are hierarchy. If something is quoted, you cannot use any other technique. You have to mandatorily use that price. Okay? Because market participants have come to a conclusion that that is the price. And that is why blindly you have to use that price only. If that is not the case, then only you can go to the other level, not otherwise.
But in
Because-
a thinly traded example, you said you have to do the fair valuation techniques and all. But then if it is traded on a measurement rate, then you can rely on that as the fair value.
Yeah. So that's
There
what
is
I'm
no
saying.
option. You have
That
to rely on that measurement.
today for a thinly traded shares, you will not take that price into account and you will use other valuation technique, right? However, that will not be possible going forward.
Sir, if there is a buyback offer going on that particular day, that price is different from the market price, then what will you do?
You have to take a market price. You have to take a market price. That is what I am saying. When something is quoted, you have to take a market price. Because somebody buying and selling will have something in mind that why it is paying a lower price or a higher price.
Sir, but in a broker's world, there will be two trading windows. So for me as an individual, I can see only one window. But for that broker, he can see two windows where he can see two quotes. For a buyback window and an open market window. So actually there are two prices.
So buyback window will be open generally for let's say next 15 days, 20 days, 30 days, right? And when you are saying that you have to do a valuation on a measurement day, you will not take into account that after 15 days when that buyback will get completed, this will be the price I will get. You will not consider that.
Because sometimes they also declare their price on a daily basis. They increase the price, which will be a maximum limit.
Yeah, so there is a maximum limit.
There will be fluctuation in their buyback window
There
also
will be
and the
fluctuation.
open market also.
But that is not the price of the measurement day. And that is why you will not consider that. Second thing is, in a buyback, you are not sure that all the shares will be purchased by that in buyback. If that is the case, it's a problem. But I am saying that although there may be a case where there is a 100% buyback possible, whatever shares you will give, then also you will not consider that shares. Because all these things, when it is other tradings are happening, the market participant will consider that. Like let's say in Sun Pharma, it was the I think 1:100 or something like the 1:30 was the buyback offer. Market price, although the buyback was I think at 900 rupees, the quoted price was around 700 rupees, and it remained 700 till the time the buyback was closed. Yeah.
If
Sorry.
I invested outside India, the
Yes.
foreign money which is listed outside India.
Yes.
So the fair market value of that will be which market value are you considering?
Yeah, so if that is traded in, let's say, US market, you will consider that price and convert that price into rupees and take that into account as a fact. So if it is quoted anywhere in the world, okay, you will take that price, use the conversion exchange rate, and then take it.
RBI exchange rate happening?
Yeah, RBI exchange. No, but the things also may come when, let's say, it is not quoted outside, but still you are holding the foreign company shares, and how it needs to be valued. So there basically, when you are comparing the similar companies, you should not compare the Indian companies, you should compare the similar companies where that is situated. So that I think you should keep in mind.
And sir, last time I asked a question, if that company say migrated from Mauritius to Singapore or other countries, so again I have to get de-recognized and then I have to fair market value that share, or how I do that?
No, so if
invested in Mauritian company, that Mauritian company migrated, not resolved and then again incorporated, it is migrated to Singapore. So I have to see the Singapore market then. In first year I will value fair market value as per the Mauritian market. In second year I will value as per the Singapore market.
So see, if it is quoted in Mauritius or Singapore market, you will have to consider that. But otherwise, it is, so most of the Mauritius investment is a pass-through, right? So it is not that any particular thing is, any manufacturing unit is there or nothing is there in Mauritius, right? So you will not consider the Mauritius, comparable, because you need to compare similar company. When it is similar company, you will say that my manufacturing unit is, let's say, in Ireland. I will consider the company which has another unit in Ireland, and then I will consider. But if it is a conglomerate, so it is at all the places, then you will consider some other company which also has units at all the locations or different locations. So you will have to find out the comparable company, right? But because it is a Mauritius, it is coming to Mauritius road, you will not compare that company. Unless it is quoted, let's say if it is a Mauritius company and it is quoted in Mauritius exchange, you don't have any choice but you have to use that, but not others. Yeah, you will not consider the migration happening. Okay, let's say today a company which is quoted in India, okay, it starts quoting, let's say, in Luxembourg, right, or in US market, Nasdaq. The question is that if it is quoted at two places, what you will do, right? But take a case, so we will come to that, but take a case where a company is here, but it is only listed at Nasdaq. It is not listed at any Indian exchange, okay, and it is being traded there. What you will do? You have to mandatorily consider the market price which is quoted there, convert that into Indian rupees and take that as a fact. No choice. Okay? So up till now we were considering generally financial assets and liabilities, although those things also was applicable for non-financial assets, but highest and best use is the concept which is only for non-financial assets, right? So highest and best use for non-financial assets is as per AS 28, because when you say value and use, that is the best use which you will take. But there is a difference to an extent that if the other use may give a higher value, you will take that higher value and not the value which is value in use for you. Okay, so that's, I think, very important, that highest and best use is not same as value in use. Value in use is how you are using that asset, but the best use is that what market participant will be able to use that asset for. Okay. So if you have let's say a factory which is, there is no manufacturing going on there, but there is a factory building and there is a land which is there, right? So for you, value in use, because you are not using that for your manufacturing, value in use may not be that high. You are using that land for your factory, for your manufacturing units, so that's why also for you value in use will not be high. But there you will consider that if any market participant will take that land and building, what he will be able to do with that. Whether there will be a real estate, he will be able to develop and sell that. Then if that is giving a higher price, so that is the best use of that particular asset, then you will consider that into a fair valuation. Follow? So not value in use in your case, but best value of use, best use. Fair value considers the market participant's ability to generate economic benefits by using the asset in its highest and best use. Highest and best use are considered after taking into account physically possible, legally permissible and financially feasible. So you need to consider that, and if something is not legally possible because let's say there is a unit in SEZ and it has certain restrictions on use of that particular land or particular property, then you need to consider that. So legally permissible, if it is not there, you can't have the value which is there for generally for that real estate. And financially feasible, so maybe possible that anybody will not be able to use that, because if let's say there is a land and you need to develop that, you will require a sufficient financier, and that financier or that builder who is capable of taking that, you will consider from that point of view and not from a general point of view. Current use is presumed to be the highest and best use. So it is presumed, but it is not necessary to be highest and best use, as we have discussed earlier. Highest and best use is always considered when measuring the fair value, even if the entity intends a different use. So this is also important, because if you have a manufacturing unit and it is not earning enough, so value in use will be lower. You are not planning to sell that, but that you will not consider that when you are working out the fair value, that you are going to continue that manufacturing. You do not have any plan to sell that particular factory. You should not consider that. You should consider that if this plant is being taken by a builder, and if he is able to, demolish whatever factory building is there and will use for the real estate purpose, development and sale, what price he will pay, you will consider that, right? So it's different to that extent from RAS 28. So highest and best use also, it can be either on a standalone basis, or it can be a combination of assets or a liability, or both put together. So the concept of CGU, cash generating unit, if you will say that by combining certain assets or by combining certain assets and liabilities, it will give you a higher value you will go by that and not by a single sale of assets. That is only in case of a non-financial assets. You need to keep in mind, you cannot apply this because in financial assets we have talked about unit of account will be one share or one security. But in non-financial assets it is possible to aggregate the assets or liabilities which will be best suited for giving a higher value. Assume the complementary assets liabilities are available to a market participants. Complementary liabilities includes liability that fund the working capital but excludes liability to fund assets outside the relevant group. So CGU concept basically. Assumption must be consistent for all assets and all liabilities of the relevant group. So in non-financial assets, aggregation is possible of related assets and allied. Land acquired in a business combination is currently developed for an industrial use as a site for manufacturing facility. Nearby sites were recently developed for residential high-rise, and it was determined that the land could be used to develop residential high-rise. So what you will do in this case, the highest and best use is not what you are putting the value or what you are using, but it will be what other builder will take it, because here I think it is clear that it is feasible, it is legally possible, because another next site is also is being used for a real estate development, and you have the asset land which can be sold easily, so that can be taken. However, you will take into account that for demolition of whatever activities which are there, for if anything needs to be shifted, then if there is any price to be paid for that, you need to consider that, because anybody who will take over and on as and where basis will have to do that, and that is why you need to take that into account. The value of the land used in manufacturing operations, so the value of the land as vacant site for residential use. Not that the transformation cost, example cost to demolish the land, would be considered in value of the land as a vacant site. So you will consider that demolition price which you demolition cost which will be. Yes, now coming to another concept of principal market and most advantageous market. So the standard says that you need to first consider what is quoted at the principal market. Okay, if principal market is not available, then only you have to go to most advantageous market. Okay, so many times the people will feel that I will take most advantageous market only for me, but that is not the case. If your principal market is there, you cannot take into account what is quoted at most advantageous market. Okay, so that you need to keep in mind. So now let us consider what can be considered as a principal market. Market with greatest volume and level of activity for the assets or a liability. So wherever the volume is higher, it will be presumed to be a principal market. You need to consider that as a principal market. Entity must have access to that market on a measurement date. I think that's important. In some cases, if you do not have access to the market, because let's say it is a market where only you have to become a member and it is only transaction can be done only between the two members, then in that case, if you are not a member, you do not have access to that market and you cannot take that into account. That market you need to enter. There is a rebuttable presumption that the principal market is a market in which entity normally transacts. Okay, but doesn't mean that it has to transact in that market. Not necessary. You may, for whatever reasons, can go into another market when you have to actually trade. But wherever higher volume is there, that needs to be considered as a principal market only for fair valuation. Right? So we'll take an example, but I think that's going to be. Yeah, or otherwise we can solve here. So maybe in 10 minutes we'll break. After looking at this principal and most of it. So principal market is only where it is highest trading. Okay. So highest trading, you need to consider a volume. Okay. It may be possible that volume multiplied by price in some cases may be higher at other market, but here it will be only volume and not the price, because when we will arrive at the principal market and then only we will consider price. Okay, so only volume needs to be considered. Now, if principal market is not available, then it has to be most advantageous market. Market that maximize the amount that will be received after transaction and transportation cost. So, in arriving at the most advantageous market, you will consider all the cost, but not for the fair valuation purpose. Though you may say that principal market is not available, so I am going by the code of the most advantageous market. And when you will arrive at most advantageous market, you will consider what is the net realizable value for you. What finally you will get it in your hand. Okay? But after that, you need to follow the principle that you can't consider a transaction cost, you can't consider a transportation cost unless it is a characteristics of that asset. Right? So you need to keep that in mind. So let's take an example now. There are three markets, annual volumes are 30,000, 12,000 and 6,000. Transaction per month are 30, 12, 10. Prices are 50, 48, 53. And there are transportation cost and transaction cost. So what is the principal market here? Where there is the highest trading, volume wise, which will be market A, right? Whether there is a relevance to a transaction per month in this case. Whether there is a relevance to transaction per month, number of transactions which are happening is relevant or not? Is relevant. Why? If there are, let's say, transactions per month are 30, which is given here, but only one trade is one share is traded. Okay, so that will be only 30 shares which are traded. In another market, there may be 5 transactions, but 5,000 or 50 shares are traded. You need to consider the total volume. You should not consider the transaction, item of transaction in volume. So you should consider the total volume. Now the question also comes whether you need to consider the annual volume or whether you need to consider that day value on a measurement date value. Yes?
annual or 1 day is not necessary, but a reasonable period.
Right. Generally, you will consider the annual volume, but it is not necessary that you need to consider annual volume, but you should not consider only measurement date volume. Okay, because most advantages of market means that you have access and you will be able to trade during the period. So generally, annual volume or a quarterly volume or a monthly volume you can consider.
So why I am saying reasonable is because the example which you gave about the residential buildings. Now, it so happens everything may be possible, but the market for sale is dried up.
Right? No, so you need to consider a larger period of volume. And you should not consider only measurement date volume. That is 100%. Here there is a transport cost involved and transaction cost involved. So we have arrived at the principal market is market A, right? Entity usually trades in market C, it is written. You will not consider that, because although entity will trade in market C, your principal market, which is here, is market A, and you will do a valuation based on that. So if that is the principal market, what will be the value? Net proceeds is 46, quoted value is 47, price is 50. Yes. So when there is a principal market, what we need to consider? In working out fair value, what we need to consider?
Quoted value.
Less transportation cost if it is a characteristics of that asset. So here, if we will presume that transaction cost is required to transfer the assets, then in that case quoted value will be 47, right? But if transportation cost is not characteristics of that asset, then it will be 50. So here let us assume that it is a characteristic. So you will value, fair value is 47, right? Now let's look at if there is no principal market. What you would have taken? Most advantageous market, right? So here, let's say volume is not given, and then what you will consider for you most advantageous market is which one? Which will give you the highest net proceeds. So highest net proceeds that is there in market C. That is why you may be trading in that market. But what will be the fair value? Fair value will not be 48, because for a fair value you will not consider transaction cost, and that is why the value will be 49, your realized value may be 48. Okay?
Sir.
Yeah.
There is one line you have taken that rebuttable presumption that principal market is market in which entity normally transacts. So if a company is entity in market C and it's transacting only market C, then the principal market would be market C only.
So entity trades in market C, here it is given. Okay?
There also principal market is market A.
So that's why principal market is nothing to do with where you are trading.
But
What?
in the earlier slide it was written principal market. Rebuttable presumption that principal market is market in which entity normally transacts. In earlier slide you were
let's make it clear that when there is a principal market available, you don't have to go to most advantageous market. You should not do that exercise at all, right? But where principal market is not available, then only you need to go to most advantageous market for valuation purpose. So when it is most advantageous market, absence of a principal market is there, and that is why you are coming to most advantageous.
Can there be situations there are more than one principal?
Not generally, because volume will not be same at both the places, right?
Okay, volume will be the deciding.
Volume will be deciding factor, so volume will not be the same. Okay? Yeah. So I think we can stop here. Liquidity and all that is considered. So, but the market at which when it is there, I think we need to keep that in mind. So we'll wait for 15 minutes.
For this team, 15 minutes.